I'm Charlotte McLeod with the Investing News Network, and here today with me is Lobo Tiggre, founder and editor of independentspeculator.com. Thank you so much for being here in person with me.
In person, happy to be here. Wish you were here too, audience.
Maybe some of them are. So we're here at BRIC. It's day one. It's very early on day one. We have a whole bunch of...
But it's bustling. I'm so happy. I mean, it's not just we're here, like people are here.
Yes, tell me.
Busiest show I've seen in years, I think.
I haven't been downstairs very much yet. So yeah, are you seeing a lot of people? What does the sentiment seem like?
Early days, but happy vibes. It's good to see, especially with, some gold and silver bugs, moaning about, why isn't it higher and so on. But no, the sentiment here so far seems pretty positive. It's good to see energy coming into the sector.
Okay, that's great. I can't wait to go down and check it out a little bit more. So when our team was thinking about the themes that we might want to cover here at BRIC, one of the things that came up was forecasting. And specifically, does it even make sense for market watchers to make predictions during these volatile times? So I think that ties in with some of your recent writing on how economists seem to be consistently wrong in their calls. So I want to start there. What do you think is going on?
Well, the quick answer is you have to. If you're an investor, you're investing for gains. You're looking forward. You can't not look forward. You can't not make some kind of projection. But the trick is not to believe your own BS or put too much weight, too much certainty. That's my mantra. The prediction racket of making these bold predictions, charging in as though you know what will happen, and then getting your posterior handed to you when it doesn't happen. So the other side of the question, though, is right now, does it make sense to forecast? We have to, but an honest answer to the question is no. We've been in uncharted waters really since 2008, and even farther off the map since the COVID shutdowns. And now a war, the new Iron Curtain, all these things going on. So to stick to your old charts in uncharted water literally makes no sense. You have to look forward, you have to project, but just be super careful with how much weight you put in your models.
Okay, so going back to these predictions that we're seeing, the mainstream thinking right now is the Fed can use the tools at its disposal to eventually tame inflation. What do you think is actually going to happen?
Well, there's a forward-looking statement. So my projection has been for stagflation for some time. That's been my outlook since the COVID-19 shutdown started and the stimmy checks started. You had increasing money supply, you had a hit to economic activity. It seemed reasonable to me to expect that combination to be stagflation. But for what's going on and why do economists keep getting these things wrong, it goes to this forecasting question that you asked, and I have a thesis, and that is that mainstream economists, the ones in the Fed and even the ones in private sector, in the banks, they all have these models. They were all taught in school. These models don't contemplate things like stagflation. These models are based on assumptions like inflation comes from a heating economy, things like the wage price spiral. It's your economy heats up, that causes inflation. So to control inflation, you need to control the economy, slow it down. But what if that's not right? What if that's not where the inflation is coming from, which this time it seems pretty clear. Even the Fed says, well, we can't do anything about the supply side. But yet they still think that they have the tools. They're kind of talking out of both sides of their mouth. So not to get too long-winded about this, I do think, audience, that a lot of economists out there, if not most of them, are working on flawed models. This is extremely dangerous to your wealth at this time. Because if those models are wrong, the tools are not going to work the way they think. So forward-looking statement, I don't think the Fed will succeed.
Well, and the thing about, these predictions that are wrong go out into the world where they can have an impact. And that has widespread implications for the world and also for commodities. So I wondered if you could talk a little bit about that.
Sure. Well, for us as investors, it has impact. If we listen to them, if we believe them and they're wrong, then we've been misguided. But it's, as you say, a far bigger world out there. Policymakers, decision makers, they believe this. And you put this phone book sized pile of math on their desk, here's the model, here's the projections, plus or minus this much. It all sounds so scientific, it all sounds so rigorous. It's coming from Harvard or Oxford or whatever, right? It sounds so serious. And they make decisions based on this. They make policy errors based on this. And that affects us all. So long and short of it, the theory and the, the big scare is one thing, but the upshot of it is I don't think they'll be able to control inflation. I don't think they're using the right tools. I do think that as some of the supply disruptions come off, that part of it will be mitigated by itself. So they're not entirely wrong, but they are at least significantly wrong, I think. So bullish for commodities. What they're doing, I don't think, is going to tame the commodity surge at all. And what they're doing runs contra to the whole, I call it the new Iron Curtain, but the broader idea is just deglobalization, which started before the war. After the COVID-19 shutdowns and people realized how not anti-fragile the world economy is, and started thinking about, pulling supply chains home, energy independence, all these things. It's all a deglobalization trend, which means giving up those global scale efficiencies, which means higher costs, higher inflation. I think all of this is actually quite bullish for commodities going forward. I think, while errors persist, there are headwinds for the monetary metals, gold and silver. They're not just commodities. But as those errors become evident, I think it's actually extremely bullish for gold and silver.
Okay, yeah, and of course that's one of the questions on my list is, most people, they don't want to just survive in these times of volatility and big changes in the world. They want to thrive and profit. So let's talk about maybe some of the best opportunities that you're seeing right now. We have gold and silver. We've talked frequently in the past about uranium. Are those all still on your list right now?
Yes, they are. I have to tip my hat to uranium here. As as I always say, aside from the possibility of a major nuclear incident that causes the whole sector to tank, which would happen if there was a nuclear incident. If you go anywhere in this space, you have to accept that that is a possibility. If you can accept that, I think uranium is the most baked in the cake upside here of all of them. The demand is increasing, China building hundreds of these plants, Europe pivoting towards, and you'll have the whole, green agenda coming to a crisis moment where they're digging up more coal, for Christ's sake. So all this is extremely bullish. The fundamentals actually align with the technicals over the last years. Uranium's been on a 2 steps forward, 1 step back thing that we've talked about. And we are in a 1 step back phase right now. And the caveat here is that if there's a market crash or the market weakness that we're seeing in the broader equity markets continues, that will hit uranium stocks. Stocks are stocks, uranium stocks are stocks. But, higher value, lower price, that's opportunity in my view. So I really like the uranium space. On my shopping list, 2/3 of the stocks right now are uranium stocks. I'm looking to add the ones that got away from me before.
Right, and maybe we can hone in a little bit on that 1 step back that we're in right now, because we have pulled back from where we were, I think, about a month ago in uranium. And I find, when I go online, especially on places like Twitter, and I look at what people are saying about uranium, people really seem to get a little bit emotional about these things. So maybe you can talk a little bit more about that. And, if you still have stocks on your shopping list in uranium, that tells me that they have not yet gone as low as you think they could go.
Well, no, they haven't gone as low as they could go. I mean, never say never, right? But I would say that they are cheap. If I am seriously concerned about a near-term major waterfall event in broader equities markets. I think, as we were just saying, the Fed's using the wrong tools. I think the odds of the Fed causing a major reversal are very high. I think the markets think they know what's coming. They think they're ready for double tightening by the Fed. I don't think they're ready at all. So who wants to buy anything in front of that kind of potential waterfall event? If it doesn't happen, things calm down, okay, then buy. So what I'm saying is the bargains that are on the table right now, those are excellent bargains. Absent this concern about a near-term major market downturn, I would be buying now. But given that concern, I don't think they're all going to run away from me next week. So I have a little bit of time to see if things get any shakier in the broader markets, and if make my decision then.
Okay, that makes sense to me then. Speaking of major market events, one of the things that seems to be emerging as a concern is, are we going to see a recession? When might we see a recession? I don't think we've covered this before, because it's really kind of grown stronger since the last time we were speaking. What are your thoughts there?
we have touched on a little bit. There's some people I respect greatly who've been talking recession for some years, Lynn Alden and others. But anyway, and my pushback against that is, yes, I see the damage being done by policy. I can see the reasons why a recession seems, I mean, I just talked about how when the COVID-19 shut down, I talked about economic weakness and inflation. But my answer has been that if we get a recession, it doesn't have to be deflationary. That's been my pushback, is a lot of the recession camp has been saying, oh, that's going to bring prices down. But what if it doesn't? What if you have these supply constraints and stimmy checks? And, you know, what if you actually have this economic weakness and prices still going higher? We have actually seen this before. So that's one pushback, but that doesn't mean the recession doesn't happen. It just means it doesn't look like what the mainstream economic models say a recession should look like. That said, the ongoing impacts, not so much of the fighting in Ukraine, as much as I care about the humanitarian crisis for all concerned there, but the economic war, the sanctions, an economic war. And Putin's not wrong when he says it is an economic war. I think that is accurate. This is a big deal, and it's not going away, and it has costs. So I think the possibility of a recession here, instead of a stagflation where it's just kind of weak, muddling along in high inflation, but actually, retreating economic action plus high inflation, I think that's a distinct possibility. I mean, we already had negative GDP in Q1 in the United States, and they're all saying, oh, it's a one-off, it's not going to last. We'll see. If there's a negative print in Q2, that is officially a recession.
Okay, so I think that we have a pretty good idea of the things that you like to focus on within the resource space. I wondered if we could talk just briefly about, how your portfolio looks outside the resource space, outside of commodities, if there's anything you could say about that, because that's really interesting to me, especially as we have these broad market things going on.
Okay, well, before we go there, and the answer will be short, I do want to mention copper, because we talked gold, silver, we talked uranium. Okay. I still like copper a lot. Anything that goes into the new energy paradigm is of interest, but not everything is rare. We've talked about that before. Some of the prices are up on supply constraints. Lithium, for example, I don't know how long that lasts. Nickel, I'm not sure how long that lasts either. So buyer beware, but anything in this space is certainly at least the flavor of the day and can run for a while. So it's not just gold, silver, uranium, okay? And if I'm right about stagflation and the inflation part, all commodities means generally bullish for all industrial minerals and metals as well. Outside the space, given that I'm looking at high inflation, I'm looking at anything real. So if I can add to my real estate, that's of interest to me. I'm not multi-billionaire, so I'm not buying shopping malls and things like that. But I would look for real assets, real productive assets, if I could get into something on the bricks and mortar level, or even farming. I know that for years people have, farmers have shaken their heads when we talk about agriculture because it's real. But right now, that's also part of the new Iron Curtain story, right? The food crisis, that's headlines today. The Bank of England today is saying that they expect this to be a major, major global crisis. And don't ask for a raise because food prices are going up. Go figure. So yes, these are important things. Though I have to say, those are not my area of expertise. My forays outside of the resource sector are very personal. It's what I, can see needing or wanting in my own life, and I don't presume to advise people in other areas. And I do tell people that they shouldn't just put 100% of everything into my stocks. I write about what to do with your metals and mining stocks, your resource picks. I'm the due diligence guy in that area. I don't claim to be, the guy who knows all about the best REITs or, that sort of thing. But I do think you should diversify. I don't think anybody should put all their eggs in one basket, not even, my favorite uranium basket or whatever.
Well, yeah, and part of the reason why I asked that question is because sometimes when we post videos, not just with you, but with anybody, and we talk about diversification, we have people who say no, I'm all in on whatever it might be, silver or gold, uranium. And that concerns me because I don't think that's what anyone is really trying to tell these people.
Well, my mentor, Doug Casey, he taught me everything I know. Well, not everything. I have several mentors. But anyway, one of his famous sayings in this whole space, and I think everybody should take this to heart, is it's better to risk 10% of your portfolio for 100% gains than to risk 100% of your portfolio for 10% gains. Now, the context there is, your mainstream investments, they don't tend to be hockey sticks, right? Your 10-baggers aren't usually there. But he's not saying to ignore the mainstream and get out of everything else and do only mining juniors. That's not, Doug has never said that. Ideally, you could, have 10 different, completely different separate areas for speculation. I've never been able to find 10 completely different areas to speculate on, but there's no question that diversification is important, because what if we're wrong? I think what I think, I've made mistakes. I can't, as we started this conversation, you can't not look forward and project, but you have to have some humility here, some understanding of your capacity for error. No matter how certain something looks, you might be wrong. You must mitigate against that with some kind of hedging and diversification.
Okay, and so we've gone over a few of the things that we normally touch on. As we're wrapping up, I wondered if there are any developments in any of the other themes that we tend to talk about that you would want to highlight for people at this time.
Sure. I think one of the things we've talked about is the not in my backyard phenomenon, and how I think that's going to give way to the green agenda. There's just no way to achieve climate change goals without more mining. It's simply not possible. I remember seeing some think tank person saying, oh, we'll just recycle more. No, you don't understand. We need 10 times more copper than exists on the surface of the planet. You can't recycle more copper into existence. You have to mine it. So I do think this is going to change. We've talked about this before. What's coming sharper into my mind, though, is that this doesn't necessarily apply globally. The new Iron Curtain aside, just the politics and the social situation in much of Latin America, I think, is pushed back against this. I think even if the green agenda and serious fight against climate change will require more mining in areas where they regard it as gringos coming to steal our minerals, it may not matter. It may not be enough. And the movement, you look at the Constitutional Convention that just concluded in Chile, fortunately they didn't nationalize everything, but just they even considered it, right? And look at what's going on in Peru and other places, even Mexico, the populism in Mexico. So I just, word to the wise, think about your investments in Latin America and think about the social trends in those areas, because even a climate change crisis may not help if the locals are, brandishing pitchforks and torches.
Okay, and of course, those are the things that can be very easy to overlook, so I think that's good advice to end on. Thank you so much for joining me today. It's really good to see you in person, and I'm sure we'll be back together again, either in person or online soon.
I'm sure we will. Thank you, Charlotte.
Okay. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Lobo Tiggre with IndependentSpeculator.com.